what's happening now, I think, is forecasting a much bigger monetary crisis that may hit later in the year or maybe even next year, but in the dollar, in the bond market. So gold is reacting first, just like subprime reacted first in 2007. You saw the broader crisis hit a year later. Same thing's going to happen now, except it's not a mortgage credit that is the problem. It is government credit. It is sovereign debt. It is the debt of the United States. It's not a mortgage crisis. It's a U.S. Treasury crisis. That's what's coming, and a U.S. dollar crisis. Gold and silver are your early warning signs.
Gold and silver are now moving through a phase that suggests a profound shift in how these metals are being valued by the market, not just a short-term surge driven by speculative excitement. The explosive rally that set new records earlier in the week was followed by sharp intraday pullbacks, yet prices continued to hold near historic highs. This behavior is significant because volatility at elevated levels usually signals consolidation after a breakout, not a collapse. Peter Schiff has repeatedly stressed that when markets remain resilient despite aggressive selling, it often reflects deep underlying demand that is quietly absorbing supply, setting the stage for another advance rather than a reversal. Silver's action has been even more revealing, with wider daily swings highlighting mounting stress in the physical market. Schiff has emphasized that the window for buying silver at much lower prices has effectively closed, as supply dynamics are tightening in ways that are not immediately visible through paper pricing alone. Even brief declines in spot prices risk being offset by higher premiums on coins and bars, meaning buyers may still end up paying more despite apparent pullbacks. This creates a structurally bullish setup where consolidation serves to strengthen the market's base and gradually pushes the perceived value of silver into a higher long-term range. At the same time, Schiff points to a major disconnect between precious metals prices and the valuation of mining equities, which still reflect assumptions rooted in a much lower price environment. Despite gold and silver trading at levels that dramatically improve margins, many mining stocks remain undervalued as if current prices are temporary. As confidence grows that these price levels are sustainable, and as fundamentals continue to improve week by week, this gap is likely to close. The broader implication is that the market may only be in the early stages of a much larger revaluation cycle, raising the question of whether today's record prices will eventually be seen as merely the foundation for even higher levels ahead. Now, we present the clips from Peter's interview. Before we continue, please subscribe to our channel and activate the bell icon to receive timely updates. Thank you, and enjoy the video.
Gold rose to a high of about 4,640, and silver was trading above $93 an ounce. We ended up closing the week for gold at just below 4,600. I think we went out about 4,594, 95. Silver managed to close the week, I believe, just above $90. Now, we went out on a down note. Both gold and silver had sharp sell-offs intraday. Silver was down over $4 at one point during the day. Gold was down about $70 on the lows. But by the time they wrapped up trading for the week, gold was only down about $20, and silver was down about $2.25. Now, silver's been a lot more volatile than gold all week, but the important point is that the volatility is taking place at these very high prices. And this is just another consolidation of this big breakout. So if you're thinking about looking for a big pullback to buy silver, think again. The opportunity to buy $50 silver is long gone, right? And you're lucky if you could buy $70 silver, but I wouldn't even wait for that because I think the supplies of silver are going to start to run low and the premiums are going to really start to blow out so that even if silver goes down, the price of silver coins and bars may still go up. And in fact, most of the move on the week this week happened on Monday. Right? So you caught the whole thing just buying over the weekend, which is what I urged all the listeners or viewers to the market wrap to do when I recorded a week ago. And I'm going to give out the same advice now. And that is, don't wait for Monday. In fact, this Monday is Martin Luther King Day. So if you're going to wait for regular trading to resume, you're waiting for Tuesday. Don't wait. I think we're going to have another huge move up on Sunday night, Monday, Tuesday. So to beat the herd or the crowd, I recommend that as soon as you are finished listening to this market wrap, you go right to Schiff Gold and buy more gold and silver. And even better, if you are not yet a shareholder of my gold fund, the Euro-Pacific Gold Fund, EPGIX, I would suggest that you buy that too. Now, again, gold stocks are different types of investments than physical precious metals. There's a lot more inherent risk when you own an operating business that is generating a profit. I look at gold and silver as a store of value, long-term, safe haven. Gold and silver mining companies are risky businesses, right? I mean, there's so many things that can go wrong when you're operating a gold mine. But the upside potential dwarfs the downside risk. And in fact, I think today was a great day for the gold mining stocks, because when gold was down about $70 and silver was down $4, these stocks were all getting killed this morning, down 3, 4, 5%. Some of them, I saw one silver stock that I own was down about 8%. Now, it ended up positive on the day. But why are these silver stocks getting hit so hard when silver is $90 an ounce? None of this makes sense. Yes, gold and silver stocks have tripled along with the price of gold and silver, but their profits are going to go up a lot more than triple. These stocks should be much, much higher. The reason they're not is because Wall Street still doesn't understand what's going on. And remember, there are really two different buyers. Wall Street, where they buy stocks, they're not buying the physical metals. They're looking at stocks. And they don't understand why gold and silver are going up. And they don't expect the prices to keep going up. In fact, they don't expect the prices to stay up. That's why they've been so reluctant to bid up mining stocks and adjust their future earnings forecasts for higher gold and silver prices. In fact, they're still assuming that gold prices in the future are a lot closer to where they were in the past than where they are right now. Now, indication that maybe that's changing was the action today, because even though gold and silver finished down on the day, most of the stocks recovered all those morning losses and finished positive on the day. They all didn't finish positive, but many of the stocks that I own not only finished positive on the day, but made new multi-year highs on the day, despite gold and silver being down. And what I've been saying is that these sell-offs are irrelevant to the value of these gold mining companies. Gold could go to $3,000 and they'd still be cheap. So what difference does it make if it's $4,600 or $4,500 or $4,300? Doesn't make any difference at all. Gold stocks should be going up every day at this point, regardless of the short-term fluctuation in the price of gold. That has no bearing on what these companies are going to earn now or in the future, and probably even more so with these silver miners, given how much the price of silver has gone up. And again, as I mentioned on my last report, very few people seem to understand that gold companies also mine silver. It just reduces the cost of their gold. And now their costs are going to collapse because the silver byproduct that they're mining when they're looking for gold is now so valuable that it is dramatically reducing the cost of mining gold. But I think the action I saw today is a little bit constructive in that maybe, just maybe, Wall Street is starting to figure out that gold and silver aren't going to crash. And eventually, they're going to realize that they're going to keep going up. And they're going to keep going up because of the fundamentals. And the fundamentals are getting better and better for gold and silver with each passing week.
Recent policy moves and political messaging in the United States are increasingly sending the wrong signal to global markets, even if that is not the stated intention. Peter Schiff argues that proposals to artificially control interest rates, combined with aggressive fiscal behavior and mounting deficits, are steadily undermining confidence in the dollar. While the currency and the treasury market have not yet experienced a visible breakdown, Schiff views the strength in gold and silver as an early warning, much like the initial collapse in subprime lending that preceded the broader financial crisis years later. In his view, precious metals are reacting first because they tend to anticipate stress long before it becomes obvious in traditional financial indicators. This time, the risk is centered on sovereign debt rather than private borrowing. Inflation pressures, especially at the producer level, are building instead of easing, yet policymakers continue to signal rate cuts rather than restraint. Schiff highlights this contradiction as a major threat to the bond market and the dollar, particularly as rising global yields add further pressure to U.S. financing costs. Unlike past crises when government balance sheets could absorb shocks, the government itself is now the weak link. Gold and silver, he argues, are rising because markets are beginning to price in a future currency and debt crisis well before the full consequences are acknowledged by Wall Street or policymakers.
Everything that Donald Trump is doing is pushing the world away from the dollar and into gold. I mean, he's not doing it intentionally, but the unintended consequence of the policies that he's pursuing are very bullish for gold and silver. Now, they're bearish for the dollar. The dollar hasn't cracked yet. The treasury bond market hasn't cracked yet. That is coming, right? Gold and silver are the early warning. To me, it's just like 2007 when subprime blew up. That was the warning that the rest of the mortgage market and the financial system was going to follow. I knew the financial crisis I had been forecasting for years was a lot closer to a reality once I saw what happened to subprime. But the reason that Wall Street was oblivious, the reason that Ben Bernanke said subprime is contained, is because he didn't understand the problem in the economy, in the housing market, in the mortgage market. So from their perspective, it was no big deal what happened to subprime. I knew it was the tip of a huge iceberg. And I appreciated the warning because I understood what the warning was about. Same thing is happening now, right? The financial crisis didn't come until a year later. Subprime blew up in 07. Financial crisis happened later in 08. And in fact, in early 08, people still thought everything was great, right? Even though we were already in the Great Recession. They didn't know about it yet. I knew about it, but they didn't find out until the end of the year when they revised all of the economic data going back a year and said, oh, by the way, we've been in this Great Recession for a year. Well, what happened with gold, what's happening now, I think, is forecasting a much bigger monetary crisis that may hit later in the year or maybe even next year, but in the dollar, in the bond market. So gold is reacting first, just like subprime reacted first in 2007. You saw the broader crisis hit a year later. Same thing's going to happen now, except it's not a mortgage credit that is the problem. It is government credit. It is sovereign debt. It is the debt of the United States. It's not a mortgage crisis. It's a U.S. Treasury crisis. That's what's coming, and a U.S. dollar crisis. Gold and silver are your early warning signs. First it was gold, and now it's silver, and of course platinum, the whole precious metals complex is flashing that the dollar is in trouble, that the U.S. bond market is in trouble. And what Trump is doing is playing a big role in that. But we also have some news that came out this week that I didn't have on Monday when I did my main podcast. So I want to get into this news that is also bullish for gold, and that is inflation and the inflation numbers. So we got the official CPI numbers came out on Tuesday, and the media initially hyped this up as if it was good news. Like, oh, see, inflation is going away, right? But here are the actual numbers. So the PPI, and these are December numbers. So the month increase in consumer prices was 0.3. The prior month was 0.2. So it got worse. And if you annualize 0.3, you're looking like 4% inflation. That's double the Fed's 2% target. The Fed is cutting rates. They're talking about rate cuts, and inflation is twice what they claim they want it to be. They should be hiking rates, not cutting rates. And how is this good? Then the year-over-year increase in the CPI, which was forecast to be 2.6, came out at 2.7. So it's worse. It's worse than they thought, right? Yet they're still talking about rate cuts, right? Now, I guess where they got the improvement, right? And this is, talk about making a lemonade out of lemons. But the consensus for the core month-over-month gain was 0.3. And instead, we rose by 0.2. That's what Wall Street was celebrating. That's nothing. I mean, it was 0.2 the prior month, so no improvement, right? And year over year, they were looking for 2.7. Again, this is the core, not the headline. They were looking for 2.7, and we got 2.6, which was the same as we got the month before. But so what? It was 0.1 lower. It's meaningless, right? And remember, the Fed wants this to be 2%. We're not even close to 2%. But what was worse than the CPI was the PPI that came out the following day. Now, the PPI, I think, is more important than the CPI because it's forward-looking, right? The PPI is producer prices. And producers generally feel the pinch of inflation first, right? Because they're buying at the wholesale level, and they get hit with the cost increases. And then they pass them on to their customers by raising their prices. So you would expect that if price increases are coming, that they will show up first at the producer level and then at the consumer level, right? That is the order. So the producer price is more forward-looking. Now, if you look at the producer prices for the month, okay, the overall number was a little bit better than expected at 0.2. But the year-over-year increase in producer prices jumped from 2.7 to 3%. 3% year-over-year rise in producer prices. Much hotter than the 2.7, 0.3 hotter than they thought. Now, the core this time came out in line. They were looking for up 0.2, and we got up 0.2. But that was double the 0.1 that we got in the month before. But here's where it gets real ugly. The core, ex food and energy, year over year, core now up 3% versus 2.6% the month before. And again, for the producer prices were a month earlier. Consumer prices were December. This is November, right? And so that's even worse because we haven't even got December yet. So we're 3% year over year. Ex food and services and trade up 0.2. And here's another number. I don't know if this is the super core or what it is, but it's the producer prices excluding food, energy, and trade services. That was up 3.5% year over year in November versus being up just 2.9% year over year in October. That is a big increase in year over year price increases in just 1 month. And the Fed is cutting rates, and they're talking about more rate cuts. in the face of already high inflation going up, right? It's not like we have above target inflation and it's coming down. We have above target inflation and it's going up. Meanwhile, everybody wants to pretend, especially Donald Trump, that inflation is gone, that it's dead and buried, right? That the Fed is just being stubborn and not cutting rates in the face of, vanquished inflation. The reality is inflation was never really dead, and now it's coming back stronger than ever, and the Fed is behind the curve. The Fed should be hiking, and instead it's planning the next cut. This is extremely bearish for the dollar. The dollar is going to roll over. This is very bearish for the bond market.
The next stage is likely to unfold as mounting fiscal and monetary pressures begin to surface more openly across financial markets. Persistently high inflation combined with efforts to artificially restrain interest rates creates a fragile imbalance that cannot be maintained indefinitely. As confidence weakens, investors may increasingly reassess the reliability of government debt and the long-term purchasing power of fiat currencies. This reassessment could trigger a gradual withdrawal from bonds and other paper assets, redirecting capital toward real assets viewed as protection against monetary erosion. Over time, this shift would place additional strain on funding costs, forcing difficult policy choices and amplifying market volatility. Further ahead, the risk is not simply slower growth, but a broader loss of trust in the monetary framework itself. If rising prices continue to outpace incomes while debt levels expand, markets may begin to price in a more fundamental adjustment, one that redefines currency values and global capital flows. Such a transition could elevate hard assets, disrupt traditional asset correlations, and accelerate structural changes in trade and finance. As these dynamics converge, the central question becomes whether authorities can manage this transition in a controlled manner, or whether the adjustment will arrive abruptly and reshape the financial landscape faster than most expect. Let us know what you think in the comments. And if this video offered new insight, don't forget to like, share, and subscribe for more updates on this unfolding monetary revolution. Thanks for watching, or